The person who literally runs America's money just gave an interview. And buried inside it was a sentence that should have been front-page news in every financial publication on Earth. He said the global financial system is being reset, not adjusted, not tweaked, reset. The last time that happened, it changed the rules of money for every person on Earth, overnight. And most people had no idea it was coming until it was already done. Here is what is happening. And more importantly, here is what to do about it. Let me give you the one-sentence version of the problem. The rules that govern how money works, how it is created, what it is worth, and who benefits from it, are being rewritten right now, and almost nobody outside of institutional finance is paying attention. The U.S. Treasury Secretary, the person whose literal job is managing the world's reserve currency, recently made a public statement calling for a fundamental realignment of the global financial system, not in a closed-door meeting, not in a leaked memo, in a public speech to international financial institutions, on the record. When the person running America's piggy bank walks into a room and says, "We need to rebuild the entire system," that is not a policy discussion. That is a warning shot. And in financial history, warning shots like this one have always been followed by significant wealth transfers, from people who did not understand what was happening to people who did. Here is the backdrop that makes his statement so significant. The U.S. national debt is closing in on $40 trillion. Gold is hitting levels that would have seemed impossible 5 years ago. Central banks around the world, the institutions that literally print money, are buying gold at rates not seen since the 1960s. And the dollar's share of global foreign exchange reserves has dropped from 71% to under 58% over the last 2 decades. Meanwhile, the average American investor's financial strategy is put money in the S&P 500, keep some cash in a savings account earning 4%, and hope for the best. That strategy worked reasonably well when the underlying rules of money were stable. It works considerably less well when the rules themselves are being renegotiated. So today, we are going to cover 3 things. First, what this reset actually is and why it is happening. Second, the 3 historical moments that tell us exactly what comes next. Third, a plain language framework for positioning your money before the music stops, whether you have $500 or $500,000. No jargon, no panic. Just the actual structure of what is unfolding and what history tells us to do about it. To understand what is coming, you need to understand what happened the last time a Treasury Secretary stood in a room and said the global financial system needed to change. It was 1944. The world had just finished the most destructive war in human history. Europe was rubble, economies were in ruins, and 44 countries gathered in a small town in New Hampshire called Bretton to answer one question: how does the world rebuild a functioning financial system from scratch? The deal they reached was simple. The US dollar would become the world's reserve currency. Every other currency would be pegged to the dollar, and the dollar itself would be backed by gold at a fixed rate. This created something remarkable. For the first time in modern history, the world had a single, universally trusted unit of account for international trade. And because the dollar was backed by gold, there was a built-in limit on how many dollars could exist. You could not print more dollars than you had gold to back them. That discipline made the system credible. The result was the longest sustained economic expansion in American history. The post-war boom. The American middle class. The suburbs, the highways, the factories, the global dominance of American industry. All of it was built on the foundation laid at Bretton Woods. But here is the part that matters most for investors today. People who understood what the Bretton Woods Agreement meant and positioned their assets accordingly built generational wealth in the decade that followed. People who dismissed it as abstract policy and kept their money in the wrong places watched inflation quietly erode everything they had saved. The reset created winners and losers, and the difference between them was almost entirely about whether they understood what was changing. Sound familiar? Because the Treasury Secretary is now using the phrase Bretton Woods realignment to describe what is happening today. He is not using that language casually. He is a career financial professional who understands exactly what those words mean historically, and he chose them deliberately. The second historical lesson is less celebrated and more directly relevant to what is happening right now. By the late 1960s, the original Bretton Woods system was under enormous stress. The U.S. had been spending heavily on the Vietnam War, on social programs, on maintaining its global military presence. The government was collecting less in taxes than it was spending. To cover the gap, it was printing dollars. But here was the problem. Those dollars were supposed to be backed by gold, and foreign governments, particularly France, looked at the math and realized the U.S. had printed far more dollars than it had gold to support. So they did the logical thing. They started demanding their gold back. France literally sent a warship to New York to collect its gold. Not a metaphor. An actual naval vessel. Because when you suspect someone has been writing checks their account cannot cover, you go collect the cash in person. In August 1971, President Nixon closed the gold window. The dollar was no longer convertible to gold at any price. Overnight, the foundational rule of the global financial system changed. What happened next is the most important financial lesson of the 20th century for ordinary investors. With no gold backing, limiting how many dollars could be printed, the government could, and did, create money to cover its deficits. More dollars chasing the same amount of goods meant prices rose. Inflation, which had been relatively contained under the gold standard, became a structural feature of the post-1971 economy. Here is what that means in plain English. If you put $100,000 in a savings account in 1971 and earned average interest, you lost purchasing power every single year. Not because the bank stole from you, because the number of dollars in circulation kept growing while the amount of real goods and services grew more slowly. Your savings earned interest, but inflation outpaced it. Meanwhile, people who owned physical assets, real estate, gold, commodities, businesses, watched those assets rise in price as each dollar became worth less. Not because the assets themselves became more valuable, because the measuring stick got shorter. This is not ancient history. The same mechanism is running today. The U.S. government currently collects roughly $5 trillion in taxes and spends closer to $7 trillion. The $2 trillion gap gets borrowed. The Federal Reserve buys treasury bonds. New money enters the economy. Prices rise. If you are keeping a significant portion of your savings in cash right now, in a savings account, a money market, under the mattress, you are not playing it safe. You are slowly losing a guaranteed percentage of your purchasing power every year. The Nixon shock taught us this 50 years ago. The lesson has not changed. The scale of what is happening now is just larger. The third historical moment is the one that most directly maps to what the current administration is openly planning. In 1985, the US dollar had become extremely strong relative to other major currencies. American manufacturing was struggling to compete globally because US exports were expensive for foreign buyers. The trade deficit was widening. American factory jobs were disappearing. So the finance ministers of the world's 5 largest economies met at the Plaza Hotel in New York and agreed to deliberately weaken the US dollar through coordinated intervention. The dollar dropped roughly 40% against major currencies over the following 2 years. A 40% dollar decline sounds abstract until you translate it into real money. American tourists visiting Europe suddenly found their dollar bought 40% less. Imported goods got significantly more expensive, but American manufacturing became dramatically more competitive globally, and industrial stocks Commodity producers and domestic manufacturers significantly outperformed the broader market during that period. Now, the current Treasury Secretary has publicly called for a similar agreement. His team has put numbers on it. The proposal is for the dollar to weaken by somewhere between 20 and 40% through a combination of tariff policy and diplomatic pressure on trading partners. This is not speculation. This is stated policy from the person running the U.S. Treasury. If the dollar declines 30%, your European vacation gets 30% more expensive. But American-made products become 30% cheaper for the rest of the world to buy. Domestic manufacturing gets a massive tailwind. Energy production, where the U.S. is now the world's largest exporter, becomes significantly more profitable in dollar terms. And every asset that is priced in dollars but has real-world value, real estate, commodities, productive businesses, goes up in nominal dollar terms simply because the measuring stick got shorter. The people who were positioned in hard assets during the post-Plaza period did extremely well. The people who held dollar-denominated savings accounts were quietly paying a 30% tax they never saw on a receipt. History is not repeating exactly, but the rhyme is unmistakable, and the people making the policy are explicitly referencing these historical moments as their models. Okay, enough history. Let's talk about what you actually do. I want to give you 3 questions, not investment tips, not stock picks, but questions that force you to look honestly at your current financial position in the context of what is structurally changing. Question 1. How much of my net worth is in cash or cash equivalent assets? If the answer is a lot, and you are keeping it there because it feels safe, understand what you are actually doing. You are making a bet that inflation stays low, that the dollar stays strong, and that the status quo continues. Based on stated government policy, all 3 of those assumptions are under direct challenge right now. A savings account earning 4% in an environment where the true cost of living is rising at 5 or 6% is not a conservative investment. It is a slow, guaranteed loss of purchasing power with the appearance of safety. Your grandparents' advice to keep money in the bank made perfect sense when interest rates exceeded inflation. In the current environment, it is a financial plan that erodes wealth on a schedule. Question 2. Where is my money actually exposed? Most people think they know the answer to this. They own index funds, so they own America. But here is the nuance worth understanding. The largest components of the S&P 500, the technology companies that make up 30% of the index, generate 40 to 50% of their revenues outside the United States. A weakening dollar actually helps their reported earnings. A trade war that disrupts global supply chains hurts their margins. You may think you own one thing when your actual exposure is considerably more complicated. Before making any portfolio changes, understand specifically where your current holdings generate their revenue, not where the companies are incorporated. One rule worth applying. If you cannot explain in 2 sentences why you own something and what conditions would make it go up or down, you do not actually understand your exposure. You are just hoping. Question 3. What is my plan if scenario B plays out? There are 2 broad outcomes from a financial system reset. Scenario A is the managed transition. The dollar weakens gradually, trade deals get renegotiated, manufacturing returns over a decade, and the system stabilizes with a new set of rules. For investors who are broadly diversified into hard assets and productive businesses, this is manageable and potentially very rewarding. Scenario B is the disorderly version. Currency volatility accelerates faster than policy can manage. Inflation re-accelerates, credit markets seize, and a crisis forces changes that nobody had time to prepare for. History tells us that financial resets almost never go as cleanly as the people designing them hope. The 1971 Nixon shock was supposed to be a temporary measure. It became permanent. The Plaza Accord weakened the dollar more than intended and contributed to asset bubbles in Japan that took decades to unwind. Resets have unintended consequences. The correct response is not panic. It is preparation. The difference between scenarios A and B for your portfolio is largely about diversification across asset classes, across geographies of revenue exposure, and across the spectrum from growth to preservation. Practically, that means some allocation to hard assets as insurance, rather than speculation. Some geographic revenue diversification through the companies you already own. Reduction of pure cash exposure beyond what you need for near-term liquidity. And a clear understanding of what you own and why, so that when volatility arrives, you have a framework for decisions rather than a gut feeling. Let's bring it home. 1. The U.S. Treasury Secretary has publicly called for a global financial system realignment, using the same language as the 1944 Bretton Woods Agreement that last reset the rules of money. This is stated policy, not conspiracy. 2. The post-1971 Nixon shock taught us that when dollar printing replaces gold backing, inflation becomes a structural feature, and cash savers lose while asset owners win. That mechanism is operating today at larger scale. 3. The proposed dollar weakening of 20 to 40%, modeled on the 1985 Plaza Accord, would benefit domestic manufacturers, energy producers, and hard asset owners while eroding the purchasing power of dollar-denominated savings. 4. The 3 questions that matter right now. How much of your net worth is in cash? Do you actually understand your real exposure? And do you have a plan for the disorderly version of this reset? 5. You do not need to be perfect. You need to be prepared. The people who built wealth through previous resets were not the ones who made the right call at exactly the right moment. They were the ones who understood the direction of travel and positioned accordingly before the consensus caught up. Here is the honest truth about financial resets. They do not announce themselves on the front page of the newspaper. They get described in the language of policy and regulation, language that is deliberately boring, deliberately technical, and deliberately unlikely to cause the kind of public reaction that would complicate the plan. The Treasury Secretary did not go on television and say, "Your savings are going to be worth less." He said, "Bretton Woods realignment." Same thing, different packaging. You now understand what that packaging contains. If this kind of structural financial analysis is useful, subscribe. Every week we track the policy moves that are reshaping the financial landscape before they show up in your account balance. And drop a comment right now with your honest answer. What percentage of your current net worth is sitting in cash or savings accounts right now? And after watching this, are you rethinking that number? Tell me where you are. I read every comment, and I want to know what you're actually working with